The following was recorded in front of a live studio audience at the Studio 21 Podcast Cafe. This is the United Podcast Network.
This is Africa Diaspora Connect.
Join us as we take the journey from the motherland to America.
We share our experiences and learn from them.
Here is our host, Kibathi Gaturu.
Welcome once again. This is yet another special show from the Africa Diaspora Connect, shooting up from Studio 21, our home, and I am your host, Kibathi Gaturu. Today, I have a fabulous guest, man. I've known this gentleman for almost 2 decades, and he has shown me the ropes of these United States. Coming in here, trying to figure out myself. It's going to be financial literacy. Yes, an eye-opener, folks. This man, my coach for many years, is going to walk us through that. Before that, let me pay some bills and let you know that this episode is brought to you by Primerica Financial Services. For over 40 years, Primerica licenses representatives have educated families about how to better prepare for a more secure financial future. You heard it. We assess needs, providing appropriate solutions through term life insurance, mutual funds, annuities, and other financial products. They insure approximately 5 million, or rather we insure about 5 million people and have over 2 million clients' investment accounts. Check that out. We are the number 2 issuer of term life insurance coverage in North America. Primerica stock is included in the S&P Mid-Cap 400 and the Russell 1000 stock indices and is traded on the New York Stock Exchange under the symbol PRI. For queries on quality life insurance, setting up college funds for your illustrious children while they're still young, planning for your retirement, understanding your financial pulse with a free financial needs analysis and an opportunity to become a licensed representative, look no further. Reach out to Sam Yanka at the Top Gun Bay Shop, Senior Vice President at toll-free 800-206-8917. Tell them KG Kibathi Gaturu referred you to him. Coach, man, finally got you in here, man.
A long time, but you've been asking me.
Man, listen. You know, I finally found my other calling in my 5th decade in my life. It took me a while to find myself, you know, but I'm here doing it. Hey, listen, I got over 1,500 subscribers. You know how many? That's a huge base shop, don't you think?
Yeah, I would say. It would be nice if you get them all clients. I'll promise you that, Kibathi, no doubt.
Listen, man, we know the hustle, man. You know, one of the things that I learned from you over the years, it's been almost 20 years we've been doing business, is, you know, we come here, immigrant mentality, we work very, very hard. We put in our doubles, we put in our time, but we've never understood the concept of how money works. And what you did was very instrumental for my life. Starting off a young family, buying my house. I remember the first time I just bought the house. You came down and just opened up to me. And that, to me, was the catalyst. Understanding how our hard-earned money works. So let's start off. Tell us about, you know, how does money work, man? What's this thing called a dollar, man? We work so hard. How does it work? How does it work?
You know, the first thing you understand is everything comes with instructions, except your paycheck. Right? Your paycheck doesn't come with instructions.
True.
So consequently, what happens is most people live paycheck to paycheck. You're thinking about it in America today. They're saying almost 70% of people live paycheck to paycheck. Like you said, you know, in your community, people are working doubles and triple shifts to try to get by, or to try to get ahead.
Yeah.
I understand that. My parents came from another country. They came in with the same mentality, right? Yeah. Worked their tail off, but they never could get ahead because nobody ever explained to them money.
Yes.
Right? So I think what happens is we take our education from our friends, our relatives who don't know anything about money. That's how I got all my education.
Our broke relatives,
our broke relatives, right? They're more broke than you. Good piece of advice. Never take financial advice from somebody more broke than you are, right? I mean, that's the bottom line. But they all have opinions of that, right? So the first thing you got to understand, I think the first thing that really woke myself up 34 years ago when we were approached and somebody came and talked to us about Primerica, because we were doing everything wrong. My wife and I, we were doing everything wrong. We had the wrong insurance. We didn't have any savings. We were broke, right? Just barely getting by. But what opened my eyes was this thing called the Rule of 72, right? This bypass the middleman concept. The fact that how money really works is we give our money to these institutions. Banks, insurance companies,
credit companies,
they take our money. Well, banks are not savings institutions. They're lending institutions.
All right.
They need you to put your money there so they can lend it out or they can go invest it themselves. So they use your money. They earn X amount of percent, whatever that might be, 8, 10, 12%.
Savings account. I just landed from Zamunda, from the motherland, and I have a savings account. Come on now, Sammy, I got a savings account.
Yeah, well, they say that's great, but what do you think they're doing with that money in that savings account?
Tell us, educate
us. Well, they're not putting it in a vault. That I can promise you. Okay.
What are they doing with it?
They're taking that money and they're using it. It's common sense, right? Most people at your ask that understand that banks use your money.
There we go.
Right, but what they don't understand is the impact on you when they're using your money, how much of that difference is, right? Yeah. So am I saying that banks are bad for everything? No. I mean, obviously, you need a checking account. You need an emergency fund, right? Yeah. But you shouldn't be having the majority of your lifetime savings or your long-term savings, your intermediate savings sitting in a bank because they're just using it. Yeah. They're earning 8 to 10% interest. They're paying you 1 to 2%. Difference is their profit. And that profit over time is a lot. So think about it this way. I mean, most people, I know you guys everybody buys houses. They want to buy houses, and everybody tries to get a lower interest rate, right?
True.
So if you look at an interest rate, say over 30 years, a 1% difference in an interest rate could be almost $30,000 or $40,000 over the life that you pay in interest. Yeah. It works the same thing on your savings. A 1 or 2% growth more in your savings means $40,000, $50,000. Imagine if that difference was 6 or 7%. Wow. You're talking hundreds of thousands of dollars of difference in your savings, in your future, right? Yeah. If you don't understand this bypass the middleman concept.
Bypass the middleman concept. ADC, you're hearing it right here. Bypass the middleman.
Right. That's it. And by the way, that woke me up. Wow. And the next thing that woke us up, really, the big thing was that we found that the biggest middlemen in the country, right, are life insurance companies. Understood. Right? They sell all these products and they try to convince people that these products are savings programs or those kind of things. But the bottom line is they're nothing more than a gimmicks, right, to get you to save money with them. Understood. And so insurance companies have more money than banks, really, to be honest with you. They have. I mean, you've never seen a poor insurance company, right? No, you because haven't.
all the tallest buildings are named after insurance companies.
Exactly right. I don't think there's a building over 10 stories that isn't owned by an insurance company, right? And that's the reason why is they're using your money. Yeah. Right? They're sucking you in to buy these cash values by promising you certain things. And we're going to talk about insurance.
We're going to get into that.
We're going to get into that afterwards. Exactly right.
You touched on the rule of 72 as you were opening up. Let's touch on that. The rule of 72. What is that?
The rule of 72 is basically it's called the banker's rule, right? And all you do is you take the number 72 and you divide it by your interest rate. I think there's a slide that's going to come by the screen.
There's a slide. One of the slides.
One of the slides coming by the screen is going to show that.
Chris is going to bring it up when it comes to it.
Okay, cool. So basically, it's simple. So if you're getting a 3% rate of return, you divide 72 by 3. That tells
24.
You that's how long it takes money to double approximately.
Wait. So it will take me 24 years?
24 years. So if you put $1,000 in, $2,000 in, $10,000, $1, doesn't matter. If you leave it in that bank for a 3% return, it'll take 24 years for it to double.
So if my credit union is giving me 1% rate on my savings account, 1%, it will take me 72 years?
24 years for...
1%.
1%, yeah, 72 years. Your money won't double for 72 years. Yeah, exactly right.
Yeah, Odish, get your money out of your savings account.
Exactly right. Exactly right. The other part about that is, think about this for a second. So if the money's doubling every 24 years at 3%, and let's just say a 12%, because average credit cards, they're charging you 12, 18, between 12 and 20%, right? Yeah. So let's just say it's 12% they're making on your money on the credit card. Well, 72 divided by 12 equals 6. So that same amount of money that it's doubling 24 years for you is doubling every 6 years for them. So a $10,000 investment in 24 years in a bank at 3% would give you $20,000. Wow. If you invested outside, what they're making on it is they're making $160,000 over that same 24 years because that money's doubling now every 6 years.
Wow! And one of the values I love about what you taught me is we're bringing Wall Street to Main Street folks.
Correct.
You see what I'm saying?
Yeah.
Because for a lot of us, investment is not in our periphery. You know what I'm saying? Who do I trust?
Exactly.
Who do I work with? We're bringing it up close and personal for us middle class, hardworking folks to really understand the equivalence and how powerful it is to make your money work for you. And that, folks, Africa Diaspora Connect. Let's wake up. We work so hard, and I think it's cautious to say that let's make our money work for us as well. That's the smart thing to do. The rule of 72, you heard it here. Moving along, and I think with that, there's something called compound interest, which is the 8th largest compound interest.
Yeah.
You know, that in of itself.
I think the most powerful rule concept in the world was, I think that was Albert Einstein said that, compound interest.
Compound interest.
So one more think about this. I think that people also get afraid of investing because they think it's complicated. That was the other thing that woke me up. It's really not that complicated. It's pretty simple, right? It's pretty simple when you have somebody explain it to you.
Yeah.
And I think what happens, people listen and they chase returns and they don't understand how it works, so they constantly take more risk than they're supposed to take, or they don't take enough risk that they don't take enough because nobody's ever educating them. And I think that's one of the things that I can pride myself on. I think, and I've taught almost everybody that works with me, and I have almost 400 people that work in my organization. We pride ourselves on educating the consumer. In other words, if you're going to do an investment with us, you're going to understand why you're doing it, how it works, what the risks are, so so you're educated, right? I don't think banks do that. They scare you. Insurance companies scare you. Oh, you don't want to do that. You could lose all the money. And at the same time that they're telling you that, they're taking your money and doing that with it, right?
And that's exactly what they're doing.
Exactly.
So another thing, another touchy area within a lot of our immigrant communities here in the United States and living in the diaspora is it's, we come here, this becomes our home, we start raising our kids, and we're very education focused.
Right.
I mean, that's, we're raised to believe in, we got to go to college.
Right.
Like, it's like a taboo if college is not in your periphery. The thing is, we don't start saving. We don't even know. It's like college. It's like you're 18 years old and you start, okay, what do I do? Do I pull money out of my mortgage? What do I, how am I going to go to college? I'm going to get loans. What would you advise a family who's just starting off as a family, young kids, in terms of, thinking to the future when college planning is concerned?
Well, college planning, and I think that it's a very important part of your financial game plan, right? Obviously, if you have small children. There's no question about that.
Yeah.
And I would never not encourage folks to do that, to save for retirement. But what we're meeting with you, and you're in middle America, right? When you're dealing with people who live in paycheck to paycheck, and you're thinking college costs now, if you have a kid who's 3 or 4 years old today, college costs are going to be $60,000 a year, $70,000 a year by the time they get
in a state college.
In a state college, right? I don't know about that, but I mean, it's going to be there, right? It'll be up there, okay, for sure. So, in order to save enough money to really impact that, right?
Yeah.
But it's important that you do it.
Yeah.
I mean, I think that's important. You start some savings programs, right? To just when your kids go to college. But I would prioritize it this way. My first priority, I think, for a young family, obviously, to make sure they're covered properly. Second thing, I would prioritize them in making sure they have an emergency fund, money that they can fall back on, right? So if God forbid something happens, then start investing for retirement, and then start putting money away for their kids, or open up accounts because kids always are getting money.
Yeah.
And you could open up a 529 college savings plan or a Coverdale ESA, and you could start funding that. So at least you'll have some money put aside for the kids when they go to college. It's very rare that you meet somebody in middle America that is able to save enough money totally to really impact.
That's so true. And I like what you just said, and I kind of jumped the gun here, and I'm not working according to the schedule here. Of course, the foundation, the key things of, getting out of debt, whatever the case may be, and then, an emergency fund, and then, investments and whatever. Let's talk about the two you just mentioned for college funds. There's a Coverdale, and there's what else?
529.
And what's the difference?
Well, they're basically kind of pretty similar, right? The difference is the contribution limit. The main difference is the contribution limit, right? 529s allow you to contribute. I think that they continue to increase the maximum. It was when it started, it was $180,000. I think it's over $200,000, a lifetime contribution limit.
Okay.
The cool thing about the 529 is the way it's invested. You can pick certain portfolios, and they kind of track it for you as you're ready to go to college.
Okay.
Coverdales they're more not restrictive so much, but you can only put away $2,000 a year. It's not something that. So I would, if you were going to start saving, I would probably recommend a 529 plan, right? To be honest with you, because you could put more money away in it. Okay. But the cool thing about a 529 plan is if you've got like 3 kids and you got a 529 plan for your oldest, and they don't go to college. Well, you could transfer that 529 plan to the next child.
Oh, you can do that.
And you could transfer it to even the child after that. So if they don't use all the money in it, right?
Okay.
But like anything, right, because the money's in there going tax deferred, and you're going to use it tax-free for college. If it's not used for college,
you get hit.
You get hit for taxes and penalty, right? But It's very flexible because you can use it for books. You can use it for anything that has to do with college, right? So
they can buy beer.
You can't. Well, I don't know about that, but you know what? Is that a college thing? You do that in college? When I went to college, I did not drink any beer, Kibathi. No, I'm just kidding you.
That's just Kibathi being Kibathi. Go ahead.
Okay. No, but it depends on what the beer's for. If you need to get, no, I'm just kidding. But seriously, no. So that I would think if you're going to do that, you would start something like that because from time to time, your kids are always going to get for their birthdays, they're going to get money, they're going to get stuff, and you want an account that you can kind of fund for them, right? The other alternative to that would be an UGMA, a uniform gift to minor, which is really not a college fund, and most people steer away from that.
Uniform gift to minor,
and most people steal away, kind of get away from that because what happens when your child turns 18, it's their money. Whether you want it to be there or not, right?
Okay.
They can go get that money. It's theirs. You can't use it for anything but for them.
There we go.
Right? So, but the key is just, you can use it for anything.
Yeah.
You could use it for beer in college, okay? Okay?
Did I just say that? I don't know what I was thinking.
But all kidding aside, right? So if you're going to, I would do something like that. But really, I would focus on really getting myself organized, making sure I was covered, because the bottom line is if your goal is to help your kid in college,
that's it.
And God forbid something happens to you, who's going to help your kid in college? Right? That's the first thing. Second thing is, it's like I always kind of relate to it like on an airplane, right? When you get on, anybody's ever flown, the stewardess says, look, if the mask come down, the oxygen mask.
You first.
Before. Right, so you can't help anybody if you're not taking care of yourself. So you've got to be in a financial situation to do that, a better situation. Yeah. So taking care of your income protection, which we'll talk about in a minute, but having your emergency fund put aside, and then getting some money set aside for retirement. And I would recommend a Roth IRA because that's money you could use. There's the way it's set up. There's a mechanism that you can use.
Let's go there. Let's go there. That was my next one. Let's talk about retirement right now. You're talking about Roth and other options. What are the advantages? There's a Roth IRA. What else? What other options are there?
First thing I would say is, look, if you have an employer, if you work for an employer that offers you a 401k that they match, then my suggestion is you put in enough for them to get the maximum match.
So if it's a 6% match, at least put in a 6%.
Exactly. At least. So that you get, because they're giving you free money.
They are.
Okay? So it'd be silly to give away free money.
That's right.
But because the way corporations and companies are right now, people are always moving their jobs. So you always want to have something outside.
Okay.
Right? Now, for the average middle-income family, all right, I would say for 90% or 85 to 90% of the people, they're going to qualify for what we call a Roth IRA as opposed to a traditional. Okay. And what Roth IRAs do is Roth IRAs allow you to put money away after tax, pre-tax money, after-tax money. So in other words, unlike a traditional or unlike your 401k, where you would put money in and get a tax deduction, right? You don't get a tax deduction for your Roth, but the money grows tax deferred. But the best part about it, when you're 59 and a half, it's 100% tax free.
So for me, it's going to be in 50 years.
In 50 years. For you, it's 50 years, yes.
Okay.
It's 100% tax free. But along the way, if you need money from a Roth, you can always take what you put in, right, and pay no taxes on it. You only pay tax and penalty on the growth if you take it out prematurely. And the government will allow you to take out what you put in first and never touch the growth if you don't need to.
Wow.
So a lot of people will fund their Roth IRAs maximum. And then if they need to use some of what they've put in themselves for kids' education, they can pull some of that out. Okay? But it's predominantly for retirement account, right? So you're kind of funding two things. And that tax-free advantage, and we're recognizing it now as, with more and more clients that have bought Roth IRAs and they're coming to retirement and they're calling up and they're saying, I need some money. How much am I going to have to pay in tax? I say nothing. It's a pretty amazing concept, right? And especially with considering traditional IRAs, there's an income limit on the deduction. So I would really say middle-income families, if you're starting to put money away for retirement on your own, which you should do, then I would suggest a Roth IRA if you qualify, 100%.
I'll give you scenarios. We change jobs every 5-6 years. You have a 401k. Do you leave it with your pre-existing company? Do we take it off? And
there's a lot of pros and cons for that. But the way I look at that is when you have your money with your company, they're controlling the money.
They are.
So if you're not there anymore, it's probably better to take that and either roll it into your own IRA. Here's what you don't do. You don't take the money and you don't pay the tax and penalty, okay, and spend
Don't do that.
You don't do that, right?
Don't do that.
The whole purpose of that savings program is compound interest over time.
Okay.
So if you're putting it, and we see this, I see this consistently where somebody will put money in, 4 or 5 years of work for a company, they'll have 20,000 built in. They get laid off or they move the job and they take the money and they'll use it for whatever.
Yep.
And now they're starting all over again, right?
That's so true.
So imagine that 15 or 20 grand with the rule of 72 if they just kept moving, compounding it, right? So the benefit of rolling it into your own IRA is you control it. I mean, 401ks have some restrictions on it, on getting the money. It has to be hardship, those kind of things, or they make you do it through loan. So many times, but you got to weigh both options, right? And that's where a professional sitting down with you will help you, right? But in most cases, I find it better to move it over on your own where you control the money. That would be my preference, right? But you got to give people the education, let them know it. They could also move it to their company, their new company that they're going to.
Yeah, they can do that as well. Now, what with Primerica, for example, what vehicles do you guys? What vehicles do we use?
Well, predominantly, 100% for me, I would recommend for our client base, right, the people we're talking to, right here, these folks, mutual funds, right? I think that very few people understand how to invest in individual stocks, and the risk is just too high. Right? Yeah. And it's too labor intensive to watch it, right? Because if you're visiting individual stocks, you're watching it all the time, right? But if you invest in a mutual fund, you got a professional money manager. Yeah. They're watching it. You pick a strategy. You put your money in. You know what you're looking for, and then every 4 or 5 years you check it against the indices to make sure it's kind of at least performing the way it's supposed to perform. Whether even if it's down, but the market's down, that's okay. But you're looking at it, and then you don't worry about it too much, right?
Yes, true.
It's the easiest way to get a piece of the American economy for middle American families.
And you do that for all your clients.
Exactly true, yes.
All your clients. Folks who are hearing right here from the Africa Diaspora Connect, one thing that we don't really understand, it's not taught in school, it's not taught in the kitchen table, is financial literacy. All right, and we don't know where to start. Well, we have it right here, ADC. Let's pay attention. Now let's go to the most touchy part of where now I believe that I do thrive. And thanks to you, Sam and Debbie, just giving me this opportunity. And this is one of the licenses that I cherish. And I cherish this until the day I can't take a walk, I can't do whatever. It's that foundation. You taught me how to build my financial house. And the most important part was the foundation in any house you're building. And you introduced that to me as something called life insurance. How many Africans do you think we've worked with?
Oh, my God, thousands, I would say. Yeah, in my career, over 1,000. Let's put it that way. Yeah. And I know you and I have just, not counting how many other clients I have in the African community, we've paid several, 4 or 5 death claims.
4 or 5, and easily worth almost maybe $2 million.
Exactly true. And probably it's closer to 5 or 6 or 7 million that we've paid in death claims in that community.
And one of the things that I tell my community, man, the system here works. It works. And you corrected me a few times when I said I've had the misfortune of having to pay out a death benefit. But listen, man, it's us being there, being that,
correct,
being in those people's lives and them believing in us. And I've seen it firsthand when I've seen children grow and become, and go into the most prestigious schools because I knew somewhere along the way I intervened. Let's talk about life insurance, man. I mean, we have when I introduced the show over we're the second largest
term insurance,
in the country.
Right.
Let's talk. Let's harp on that. Let's talk about life insurance, how it works, and the importance of life insurance and what to look out for.
Awesome. And I would say you're exactly right. I mean, when you think about this, most people will spend a couple of $1,000s a year protecting their car.
Yeah.
Which is maybe 10, 15, 20 grand, right?
That's right.
Or they'll spend even protecting their house. You ask them, what's your biggest asset? They'll say, my house.
Yeah.
Well, let's say you got a house worth 400 grand. Well, if you're making $50,000 a year, over 20 years, you're going to make $1 million.
Yep.
So you'll spend all this money protecting a $400,000 asset, but you'll spend no money protecting a minimum $1 million asset. Right, your ability to earn income.
That's right.
Okay, and out of all the death claims we've paid, and Debbie and I have been fortunate. We've been in business a long time, so we've paid many, right? Well over 150, 200, right? I've never once had anybody say to me, "Well, that's too much," right? And most of the time, what you hear from them is. When they call you, and we get the calls, and that's the other thing I think that, people say, well, people aren't worried about money when somebody passes away. That's a fallacy. I can tell you that straightforward. I will say 99% of the claims we pay, we're called many times within an hour of two. because the first thing they get is they call a funeral director or the funeral money.
Yeah.
They're calling, and the question they always ask, 2 questions: is the insurance in force, and how much coverage is it?
So this is the funeral director.
No, this is the family.
Oh, the family.
The family.
Okay,
we can't talk to them. I'm talking about the family.
The family. Okay.
Family's calling us. How much coverage is it in force? And so for me, when we sit with families, and I understand that the thought process of when people come into our country new, because they don't. If this is not at least like when my parents came here, they weren't educated with any of this, right? Somebody had to teach them. Yeah. They taught them all wrong, right? But they had to teach them. So it's a concept that's not. Rarely, because most people don't like to think about dying. They think it's a bad
thing. It's a taboo.
That's exactly. I got it right. Yeah, I get it. But the bottom line is, look, I can think of a situation. I remember it was a young guy, and I don't want to go through the circus. People might recognize it. But he had coverage. He canceled it, and then he died. Right? He got killed. Right?
I remember that.
Okay.
Actually, he died. He wasn't killed, but he died.
Yeah. So if he had. And
two young kids.
Yep. Yeah. So if he had coverage at that point, right, it's a major difference in their life. Yeah. So I always look at folks and say, hey, do you really care about your kids? If you really care about your family, is there any possible way you could put your head on the pillow knowing that family's not protected properly if something would happen to you? Because nobody knows when you're going to die. I mean, nobody has that thought process.
A crystal ball, no one has it.
Nobody has it.
Yep.
And it could happen to anybody. It happens like that. Yep. That's, if I pulled out, I brought the list with me, I could show you. I mean, this is just in the last about 8 or 9 years. These are just the death claims. We've paid a ton of them. You can see them, right? All different ages, different. They die of different things. It's crazy, right? And so for me, when I sit with somebody, I make them understand, yeah, great, you want to save money. I think that's wonderful. You want to pay $100, put $100 away for your kid's education or $200 away for your retirement. But if God something happened to you tomorrow, what bill goes away? Tell me what bill goes away tomorrow. If your paycheck stopped tomorrow and you got small kids, what bill goes away? None. They still keep coming in. And you know what?
It's an overhead.
And you and I have, obviously worked together, so I'm very familiar, and I know. How much money can you possibly collect in a Harambe? How much money can you possibly collect? Maybe enough for burial?
Yeah. We Kenyans in Massachusetts are notorious, but you'll get up to maybe 50 grand on it.
Great.
We're notorious for that.
So 50 grand
which is not going to last for long.
Yeah, 50 grand.
I had a rant here the other day. Yeah, all right, but go ahead.
50 grand, what's that cover? The funeral. If the body wants to go back to Africa,
it's 20 grand
and then 1 year, maybe 6 months worth of salary, and you're done.
Yeah.
So life insurance is something incredible that people need to get. Yeah. But now you got to figure out what kind of insurance should you buy, right?
That's right?
And I think that's important.
Yeah.
And I will tell you, going back to when Debbie and I first saw this opportunity together, the thing that hit me between the eyes was the life insurance piece. See, we had owned life insurance. I had bought it. And, when they sat with me, the problem was we were doing it all wrong. We had bought the kind of life insurance that had savings because the insurance agent had sat with me, and he dangled all these little baubles in front of me, right? Yeah. You got the savings program. You're going to get your money back.
Your savings.
You don't have to. You don't have to borrow. You can borrow from it whenever you need it. It was all these little baubles, but he never explained the other part of that, right? The fact that it was 5 to 10 times more expensive. So if God forbid something happened to me, my family was going to get a third of what they needed.
Yeah.
When I retired, because I was giving my money to a middleman, I was going to get 20% of what I could have, right? And it was a game, right? It was only a gimmick to get me for them to get my premiums.
Exactly.
I figured that out. It didn't take long because it doesn't take a brain surgeon to figure out that, look, when you put two things together, neither can move properly, but when you separate them, they're both free to go, right? So that's as simple as that.
Yep.
So buy term insurance, which is straight insurance, and invest separately. And at some point, your need for insurance becomes less. That's the other thing that people don't, that the insurance agents, they build this emotional, they get you emotional.
The law decreasing responsibility.
Yeah, they get you to, when do you need insurance more? When you're going to die? You're more likely to die when you're older than you're younger.
Yeah.
So they sell them a $50,000 policy for when they're going to die at age 80, but if they die at age 30, their kids get 50 grand and they're devastated for the rest of their life. It's not even, makes no common sense.
Underinsured.
Underinsured, exactly right.
Yeah.
So with term insurance, you buy the amount of coverage, and that's not something that Primerica said. I think this is definitely what Primerica pioneered.
Yeah.
I think it made the term insurance conversation popular, and we basically, they had to admit that we were right over the last 40 years, right? When I started, it was a major battle in Primerica, but this, over the last 40 years, has been proven right. So now you'll have a hard time finding a legitimate consumer, somebody who's not tied to the life insurance industry, saying that that you shouldn't buy term insurance, right? Term insurance is the way to go, whether it's Consumer Reports or Money and Finance, it doesn't matter.
The thing with cash value, they have all these fancy things nowadays. Oh my God.
Call them baubles.
They get all these little fancy things. Oh, you do this, you can do that. I'm like, you know what, I don't even get into it, man.
They're all gimmicks.
So what would you tell someone out there who's looking simple? Make it simple. What would you say?
Buy term insurance. So let's say you got a young family or anybody, right? If you need term insurance, buy term insurance for the term that you need, for the period of time you need it. So if you got a 15-year-old kids and a 15-year-old mortgage, right? Maybe you're going to buy a 20-year level term to get you through that process. But you also want to have a program, and that's the other thing about Primerica. The Primerica term insurance is unique because it's all we sell is term insurance.
That's right.
So our term insurance program allows you to continue it after the end of the term. In other words, you can reduce it if you needed to. It kind of allows you to follow that theory of decreasing responsibility all the way to age 100, where many term insurance companies today, they'll come out and they'll lowball you, but then at the end of the 10 years or 20 years or 30 years, you're not going to keep it. It's over.
That's right.
They don't give you any options. So I'm very proud of that, and because, like we have tons of clients, and I would say 95% of our clients are taking advantage of that. As the term comes up, they don't need the $300,000 or $400,000 anymore. But you know what? They want to keep that $15,000 or $20,000 or $30,000 in place. So God forbid for their family or whatever, if they want to do it. And Primerica allows that to happen, which is really unique in that regard.
Another cry that I hear as we're winding down is people think it's too expensive and we can't afford it. It's going to be out of whack, which is the furthest thing from the truth. And there are folks who've decided, hey, listen, what's the lowest what's the lowest amount of coverage we have?
Well, I guess my answer to that would be, how much do you care about your kids? All right. I mean, seriously, so if that question, then I know what you're getting at, Kibathi, but I just want to say that. So when someone says that to me, look, you go spend $200 here or there or whatever, going to dinner, right? You'll blow money all over the place. But, term insurance is so inexpensive. So let's say it's, to get the right amount of coverage, depending on your age, $50 to $150 or whatever a month, right? Depending on your age and the length of term and what you need. When you look at that and you say, okay, we're spending $200 a month again, as I said, to protect the $20,000 vehicle. And what's more important, when you're gone, they're not going to be able to afford that vehicle.
That's right.
Right? If you're paying for the insurance for your house, if you die, the house is gone. They can't afford to pay for it, right? But the minimum amount, I mean, I would say that I don't look at from minimums. I always try to sell or make people understand the need. And if you make people understand the need and educate them, they're going to make the right choice. I think when people start saying, well, what's the minimum? Then they're not understanding.
And they're not looking for life insurance. They're looking for a funeral expense, a burial expense. That's not life insurance.
That's not life insurance. And by the way, if a person is 65 years old, that might be what he needs. But if a person's 30 with 3 kids, that's not what he needs.
That's right.
Or if he's 50 and he's got two 15-year-olds in college, two 20-years in college, 18 years, that's not what they need, right? So,
Africa Diaspora Connect, how much do you value your kids? How much do you value those you leave behind, those that are vulnerable? That's the way we look at it. And I'm going to beat this until this dead horse comes back to life, man, because you're hearing it right here from my mentor, he's a senior vice president, man. He knows his stuff, all right? He knows what's going on. This man is financially independent. So, folks, if you want to listen to me, this is my man right here. Awesome. And there's nothing to it, folks. There's nothing to it. So in summary, let's build that house again. Let's start with just summarize it. We start, what
foundation. Life insurance needs to be the foundation. You got to protect for loss before you can invest for gain. Then you move up. Then you've got to put an emergency fund in place. Then you're going to have an account for like short-term goals, whether it maybe you want to buy a house or maybe go on vacation, those kind of things. Then invest for your retirement, and then then you work the kids' education if you have enough money to work into all that, right? But if you, again, I can't reiterate enough, if your company's offering you a 401k and they're matching, get the match.
Get the match. The opportunity of itself, if someone out there would love to be a representative, what do they need to do?
We'd love to have them. Pretty simple.
What do they need to do?
Pretty simple. Just contact us. Primerica is very unique because we have a license. You need to get licensed at Primerica, which makes us unique separately, right?
Absolutely.
The license is valuable. You see how valuable that license is. So the insurance license, investment, but Primerica subsidizes all those costs.
There we go.
right? So right now, getting involved in Primerica is a one-time fee of $49, right? $49. And Primerica pays for all your insurance licensing, all your classes, all your education, all your training. The license is yours.
Yeah.
You sign up for Primerica Online, which is our dedicated website for you to do studying and all that kind of stuff, right? And when you do that, that's $25 a month, but Primerica will pay for your entire securities licensing. So you're talking anywhere from $5,000 to $7,000 of licensing and education that you get, that Primerica just provides for you. And on top of that, you get the opportunity to either do what you're doing, which you're working on a part-time basis and making money, on a part-time whenever you want to, or do what Debbie and I did, was transition into a full-time career opportunity and built a business that has provided us, significant amounts of income and life-changing experiences and those kind of things for us, right?
Yeah. Folks,
and for the people on our team also, right?
Yeah. Folks, you're hearing it right here from Mr. Sam Yanka, Senior Vice President, Primerica. Oxford's in Oxford, Massachusetts.
Right, my office, but we have many offices, but we have one in Oxford.
The main one, many offices, and toll-free number is
800-206-8917.
All right, guys. Africa Diaspora Connect Financial Literacy right here, the ADC. So, folks, if you don't already, come on, subscribe. Come on now. The quest is 2,000. Social media, we are everywhere. Facebook, YouTube, you name it. Listen to wherever you listen to your podcast, Podbean, you can hear this amazing voice. It's going to be right there. And I do have some wisdom in it every so often, some specks of wisdom. Also, let's hear from you, viewers, listeners. What do you want to talk about on the show? Are there any topics you want us to cover? You know the email, africadiasporaconnects@gmail.com, and let us know what you want to hear. Signing out from Studio 21, Kibathi Gaturu with Mr. Sammy Yanka. Thank you, my brother.
Awesome. God bless.
Thank you. Thank you so much.
The views and opinions expressed by the hosts, guests, or callers of this program do not necessarily reflect the opinions of the Studio 21 Podcast Cafe, the United Podcast Network, its partners, or affiliates.